Our two speakers today are Dean Patch, who until very recently has been the head of ISS Risk Metrics in Australia, a part of the world's largest proxy voting advisor. And our second speaker is Colin Melvin, who joins us from the London headquarters of Hermes, where he is Chief Executive of Hermes Equity Ownership. Colin and Hermes are long-term active share owner activists, and he played a role in the establishment of the UNPRI, which many of us are signatories. So opening the batting, or to use a Pakistani cricketing expression, opening the betting, is Dean Patch. Please welcome Dean.
Thanks, Michael. It was Sartre who famously observed that it's only the guy who isn't rowing who's got time to rock the boat. As the only speaker on the program without a job, I'll reluctantly accept the challenge to wobble the super industry's corporate governance boat. For I fear that we're on a dangerous course of indifference, guided by hubris and self-satisfaction, where the appearance of progress on governance issues is more important than the reality. I want to focus today on two governance issues associated with two interconnected themes: how your brokerage money is spent and your involvement in capital raisings. There are hundreds of millions of dollars of members' money spent on brokerage that entrenches the hopelessly conflicted and commodified sell-side research that by and large ignores governance and sustainability issues. It's part of the problem that creates the excessively short-term focus in the Australian finance industry. It's part of the white noise. And whilst this industry wears its UNPRI and ESG cred as the new black, it tolerates a sweatshop where the governance research on which it depends is performed by only a mere handful of effective people. It might surprise some people in this audience to know that the total salary bill for every dedicated governance researcher in Australia is less than $2 million. Those in the funds management industry might say, well, don't worry, we're doing it. The evidence suggests otherwise. The industry's current success in dealing with governance issues is built on extremely shaky foundations. The lack of infrastructure that's looking at the downside of transactions and structures opposed to the deal porn that sell-side researchers produce is part of the problem. But establishing an effective infrastructure to look at governance and ESG risk is not the entire solution. I think we need to think about designing structures that create incentives to act against governance imperfection. It's a complex but not intractable problem. Finding people in the funds management industry who are willing to get their hands dirty to change underperforming boards and deal with structural imperfections is another issue entirely. They seem in very short supply. My experience in being up close and personal over the last 6 years with some major governance issues in Australian companies has led me to question whether the real agency problem is not between shareholders and management, but rather between savers and the intermediaries that we entrust to protect our interests. Far too frequently, there is no one standing up for shareholders when their ownership rights are violated with impunity by the craven shills of management. My observations stem from my former roles as a Director of Proxy Australia, ISS, Risk Metrics, which has now changed its name back to ISS. Though we've had more identities than the United States of Tara, our vision has been consistent. We've always acted for financial intermediaries, but on behalf of beneficiaries who we believed were served by fair, open and transparent markets. I've acknowledged before that I think I've been part of the problem. We've not been brave enough in the past to seek mandates from our clients beyond traditional voting issues, and many of our clients became far too dependent on us. Now, Colin later on may want to convince you that external engagement syndicates are the solution to governance problems. They might be part of a dynamic that leads us to a nirvana of long-term investing, but it's only when we take a more holistic view of governance, when it's embedded within your investment teams, that I think we'll make any progress. There is progress though, I mean, I think we're actually seeing a functioning market emerge on remuneration issues in Australian companies by effectively shaming people into action, but shame's a very poor regulator of human behaviour. I'd like to illustrate some of the imperfections of the current approach in the Australian industry by two examples. One's a specific deal, which is my experience with the Seven WestTrac merger, and the other is reference to a systemic problem in the way in which equity capital is raised in the Australian stock market. So, to Seven and WestTrac, this was a very strange transaction. Just to recap generally, seven minorities gave up 20% of a media company that was sitting on roughly $1 billion in cash in return for a 30% combined media and Caterpillar dealership. Now, my 5-year-old son, Carlos, would have been in favour of this transaction. He likes television and bulldozers. But for the rest of the people in the market, it was a very weird deal. There were no synergies, and a lot of the purported benefits, increased analyst coverage, less risk of Stokes misusing that huge pile of cash, were totally spurious. Not that you would have known it. Every analyst in the market thought that it was a great deal. The independent expert, of course, paid for by shareholders, signed off on it. There was barely a critical voice in the market, publicly, despite many analysts, even those within the investment banks that were advising in favour of the deal, privately expressing disbelief. We opposed the transaction on pretty simple grounds, really. We thought that the valuation methodology, that the relative values of Seven and WestTrac was open to question, and it was too heavily in Stokes' favour. But as importantly, there was a taxation benefit. I won't go into the complexity, but basically there was a $300 million gain that could only have been realised by the scheme of arrangement. It enabled the Seven media assets to be rebased at a higher figure. That $300 million gain was only going to be distributed after the transaction had been completed. That meant that Stokes got the full benefit of that, and minorities got a very minor proportion. Put simply, we thought that there was a better deal, and the situation was unusual in a controlled company where minorities had the opportunity to do that. My observation was that, time is up, sorry, that there was very little cooperation between investors, and super funds, despite being aware of many of these issues, did virtually nothing. So having stuck our head above the parapet, it was very interesting. On one day I received 3 letters in an afternoon. The first letter was from the head of JP Morgan, suggesting that we had no right to be advising people that were unqualified, that it was a ridiculous idea. The second letter was a combined letter from the head of Grant Samuel, Ross Grant, and the head of JP Morgan, Goldman Sachs, sorry, suggesting that exactly the same issue, and that if the transaction didn't go ahead, they thought that the stock would trade around $6. And then the third letter, about 30 minutes later, was from Mallisons on behalf of the independent directors, suggesting that we defamed the independent directors by calling into question their judgment. It was hilarious to me that the letters from Goldman Sachs, Grant Samuel, and JP Morgan all contained 2 identical paragraphs. Well, I put this into the public domain because they expected. What was not surprising it was not surprising that we had a difference of opinion. What was surprising is that they thought that we weren't entitled to it, and that they were prepared to use shareholders' money to effectively bludgeon us into silence. It's a matter of public record that the early stages, it's very difficult to tell, but the deal went through, of course, after some concessions that were made. I won't go into some of the illusory nature of those concessions, but it's a matter of public record that the market actually thinks that that transaction has been value destructive, and the stock traded down, even though it did go through, to as low as $5.70 recently. And the supposed benefit of Stokes not misusing the huge pile of cash is called into question when you consider that they just invested $200 million in the China Ag IPO. So you've now invested in a Caterpillar dealership, a media company, and a Chinese hedge fund. To capital raisings. Recently, the last thing that I did at Riskmetrics was we put out a paper we'd been working on for a couple of years on the way in which equity capital is raised in Australia. To be very brief, in the last 2 years, extraordinary circumstances, $98 billion worth of capital was raised in Australian companies. $2 billion of fees were paid to investment banks, yet not one bank was caught with a significant shortfall for the underwriting. $45 billion of the equity raised went out in placements. Now, I'm not against placements at all, but they are discriminatory. When a placement is sold at a discount, placed in the market at a discount, and you don't participate, this has the effect of selling your share in that company at a discount to someone else. It's a property issue. What we don't know is whether there is equity in placements. And in fact, one of our clients told us a great story where they owned 4.9% of Goodman Group. A major equitisation took place. They got nothing in the placement whatsoever. Nothing. They were a passive fund. They don't allocate brokerage. And the advisor advised the board, presumably, who signed off on this arrangement, that the passive fund would have to buy it back in the market next day. And it's a matter of public record who was selling. Our solution, partial solution to this problem, is that anyone whose ownership interest increases as a result of a placement ought to be in the public domain. There is absolutely no transparency in relation to the way in which equity is raised, secondary equity is raised in Australia, and it needs to change. Unfortunately, the silence of the funds management industry on this issue is perplexing. What we do know is that fund managers protect their interests by threatening brokers to remove brokerage. What an insane proposition, where you have fund managers spending super fund brokerage to buy alpha. We need a much better, fairer and open and transparent system than the way in which we actually raise equity capital in Australia. Whilst our flexible system may have been our saviour throughout the GFC, it's not immediately obvious that it's the right setting moving forward. So when will we really be long-term investors, such as the title of the session? I think we really will be when we're prepared to take on entrenched practices such as brokerage. I mean, the execution part of brokerage is only 7 to maybe 10 bips, yet frequently people are paying 15 and 20. When we're prepared to take on entrenched practices counter to our ownership interests, perhaps we're prepared to force on our managers an execution-only style brokerage model, or to create facilities whereby we can participate in non-underwritten raisings without leaking value to investment banks. Or perhaps when we're prepared to construct mandates which are a little bit outside the box, which give managers incentives to act against governance problems. Perhaps they could put a stock on an injury list, which they weren't rated, they weren't judged against their benchmark. There are many ways in which we can solve a complex but not intractable problem. I'd love to see a more open debate rather than this assumption that we're all just doing everything perfectly. In my opening, I said that I was a reluctant rocker of the boat because, in my mind, pointing out the problems are meaningless. It's only the rowers who can change course to be really long-term owners, and I really hope that you do. Thank you.
A good friend of mine was once an employee, or indeed head of research, at sell-side brokerage. He lost his job when the company he was working for collapsed during what you all here know as the GFC. And Roger, some years before when I first met him, explained to me very proudly before any of the financial crisis, that what he was doing as head of research was producing information, good research, which was used by investors to make investment decisions. And I explained to him, no, Roger, that's not what you're doing. Actually, you're helping transactions. You're supporting your bank in making money in the buying and selling of shares. And what your buy-sell recommendations do is promote transactions. He used to get very annoyed about this. He's since changed his mind. He saw that his colleagues who were supporting the hedge funds in dragging down the very company he worked for had other ideas about what the job was. They made a lot of money, but in a very short run. And indeed, they made some money for some long-term investors, perhaps over a short period. And that reminds me also of an initiative. We thought, a group of us, I've been involved in responsible investment and corporate governance for about 15 years, and we thought some 7 or 8 years ago we'd identified a market failure in the production of research to promote investment decisions or to produce them, in that most of the research seemed short-term. It seemed to be focused on next quarter's earnings and not on the substance of the companies that we were investing in. And we thought this was a market failure of some kind, and the way to address this would be to pay the brokers to produce good long-term research. Brokers, after all, will tend to do what they're paid to do, just as fund managers do that, you would hope. And so let's find some way, we said, of paying them more to produce this research. And so a group of 7 or 8 long-term funds, Hermes on behalf of the BT pension scheme, the universities scheme in the UK, and various others around Europe, formed what was called the Enhanced Analytics Initiative. And we set aside 5% of total commissions to promote the production of this good research. And it worked. Over about 4 years, the quantity of good research went up by at least 50%, if not 60%. Good long-term research. But it wasn't used. The brokers produced it, they knew a lot about the companies, but our colleagues, the fund managers who were doing the transactions, didn't use the research. Why is that? Well, the truth is, and it's a problem following Dean from this point of view, because I agree entirely with him, and it's practically impossible to be more controversial than he is. But the truth is that we pay them, and I include myself as a long-term investor here on behalf of the BT pension scheme in the UK, we pay them to do exactly what they're doing right now. The mandates we award them drive short-term behavior and decision-making to our detriment. That is, we're paying transaction costs and churning portfolios through the very mandates we award. And so the questions we've been asked then to look at is the investment industry, or our industry as it's put, which is an interesting way to look at it, committed to long-term investing, and what are the benefits of being a long-term investor? Well, we certainly are long-term investors in as much as we have long-term horizons, but we're not realizing the benefits of that, because what we're doing is we're sponsoring trading or transactions, and we're, broadly speaking, ignoring our ownership of the underlying asset. So even though you've signed up to UNPRI, and even though you might have 1 or 2 people looking at this, is there really any substance to communicating between the beneficiary of the fund and the company that they're investing in? And are you really thinking about in the construction of your mandates, that the kinds of behaviors you're promoting by your fund managers? Early in my career, I worked at Standard Life Investments in Edinburgh. And Standard Life Investments is an active fund management company. But at that time, and hopefully it's changed, I've not looked recently, but at that time, Standard Life, you might say, was more pseudo-active. What they did was they took bets against the index, as they put it. They overweighted or underweighted against the index. And some very good people worked there. But that approach led to a very perverse link to the incentives that they had from their clients, because what they would do is, in underweighting a stock, is they would say, well, our market weighting is 2%, so we're going to go 1% in the stock. It was a big fund, big fund manager. And the best thing that could happen for that fund manager with the 1% underweight is that the company would fail entirely, maximizing the bonus, but of course the fund invested through them would lose out. And furthermore, they had no inclination at all to engage with that company to improve its performance because they were underweight. So the ownership on behalf of the fund underlying was not in any sense communicated to those companies. And that's true of most passive or pseudo-passive strategies. And even the most active fund managers tend not to do much in the way of engagement unless they're invested in particularly illiquid securities. If you're invested in smaller companies or emerging markets, you're pretty interested in the quality of governance and management because it's part of your performance. If you're invested in liquid markets, you tend not to be. So we have a problem, I think, and the problem is to do with the way in which we as long-term investors, because we are funds, invest. It's the way we communicate with our fund managers. It's how we deal with these inconsistencies or misalignments of interest. And I think we need to look to ourselves. If you think about the UN principles, many of you I know have signed the UN principles. Principle 1 isn't entirely about this. It's about investment decision making. And when we were designing these principles, and I was very much part of this, I spent many hours in underground bunkers at the New York headquarters of the UN, working on the wording, the tortuous process over a couple of years of these principles. And what we tried to do at that time, and unfortunately it's not really being communicated in this way, is that we tried to think in Principle 1 of how you make investment decisions for the long term. It's been translated by some people as ethical investing or avoiding certain companies because you don't like what they're doing from a moral or ethical point of view, and that was never the point. The point about Principle 1 is exactly what we're talking about here today. It's about long-term investment decisions. It's about mandates given to your fund managers. It's not enough just to ask them, as some are doing, which is quite good, whether they've signed PRI themselves, but what are they doing about it, and how are you communicating with them? So Principle 1 is far more to do with fundamental decision-making to maximize value. And many were anxious about this at the start. I remember my major contribution to the PRI was to chair it when it launched in 2006. And just prior to that, we had a meeting in Boston. We'd already signed off the principles in London the previous November. And we met in Boston in January to agree the launch, which was to be in April. And so we'd said, right, no more changes. We worked on every word of the principles. Dreadful experience, and everyone was quibbling on one side, you had the religious foundations, on the other side, the US funds, and we got it set in stone, no more changes. Went to Boston, and the US funds brought their lawyers with them and said, we're not going to sign unless you change the principles. And we had to add 5 words. In the end, I spent all day brokering a deal between the French and the US funds lawyers. And the 5 words we added were where consistent with our fiduciary duty. We will do this where it's consistent with our fiduciary duty, which was so obvious to all of us, but they had to have it in there. And it's quite right. It's all about making money. In the long run, doing the right thing converges with generating value. And that's what we're here to do. One way of looking at the investment industry then is as a series of intermediaries who are in control of transactions and benefit from them, and we sponsor that. So if you think about the broker, you think about the lawyer, think about the advisor to the funds, they all somehow can generate transactions and benefit from them. One thing that I think we need to consider is a broader concept of responsible asset management. So to stop thinking about responsible investment or ownership of the asset that's owned, separate from the way in which we relate to those who invest on our behalf, but rather to join this up and to recognize then the types of mandates awarded dictate the behaviors underneath. And so where you're investing through a hedge fund or you're investing through a long equity manager, it could be either of those, or private equity, to think about what sorts of behaviors you're instilling and what sorts of transparency and accountabilities you're requiring of the manager. And I think the best fund managers are starting to do this. The hedge funds industry has had to rebuild from the financial crisis, and those hedge funds that are surviving and prospering are those that are starting to be more transparent and to align their interests properly with those of their clients. So they're looking to the ways in which they're paid, and they're, if you like, giving up short-term gain to develop a better relationship with their clients over the longer run. And we're seeing this now in the UK and more broadly. The private equity industry, which 3-4 years ago was vilified for taking companies off the public markets, raking the cash out of them, sacking all the workforce, and then dumping it back on the public markets again. They're now starting to look at their own responsibility, and the industry bodies for private equity are drawing up codes of practice, best practice guidelines. They're starting to think about this, but they need a push. Simply signing PRI isn't enough. You've got to talk to them. You've got to encourage them to improve. And that's about how you relate to them. So let's look to those mandates, and let's look to improve behavior through that approach. The key concepts here then are sustainability, responsibility and accountability, and ownership of the asset, and to communicate the proper ownership of the end beneficiary right through to the asset that's owned, not just by representation through engagement, but by looking at the mandates. The friend that I mentioned earlier, Roger, he now works for me. Roger, once head of research at Bear Stearns, Roger Hurst, now is an advisor to Hermes Equity Ownership Services. And what he's able to do now is take his very good knowledge of companies and how they work and apply them to engagement with those companies. And we use them then to help us understand company behavior and go to those companies and talk to management from a position of knowledge and understanding, using his research, his very good knowledge of companies properly to change those companies through engagement. I think that's the proper use of that kind of information. We can promote better use of it by looking at the ways in which we interact with our intermediaries and design investment mandates. Thanks very much.
Thanks, Dean and Colin. Questions?
Julian Poulter from the Climate Institute. Welcome to Australia, Colin. Thanks for coming such a long way. In November, the G20 meet to discuss the further deliberations that they started 6 months or 18 months ago regarding incentive alignment in the investment system. It was only, people seem to have short memories, but it was only that long ago when the leaders of the free world stood on the steps of Parliament and said, we must make sure that a subprime crisis doesn't happen again. And one of the key reasons it happened was the misalignment of incentives. And we're still waiting for them to fix that. Do you think that if we do sort of forego the annual bonus and the Maserati, as Michael talked about yesterday, that's going to solve a large degree of the problem? And additionally, one more question, which is, to what degree do you think people hide behind the word fiduciary, given that you won't find a definition of it in either the Superannuation Act, Corporations Law, and that we're still waiting in some regard for APRA to redefine it regarding ESG issues? Sure.
Thanks. The Maserati and the bonus are symptoms rather than causes to some extent, I think. Although one of the directors, indeed the chair of the bit of Hermes that I run, Hermes Equity Ownership Services, is Sir Mark Moody-Stewart. Sir Mark is former chair of Anglo-American, and he's remuneration committee chair at HSBC, a very large bank. And he told me a story about how he uncovered the remuneration practices within HSBC and stopped them early on through the crisis. HSBC, for a variety of reasons, didn't suffer the same fate as many banks. But what he found, of course, was that people were being incentivized on revenues rather than profits. And if you're doing that with investment products, then you've got a big problem. So I think bonuses and the ways people are paid are important. Are we likely to stop the next crisis through actions undertaken already? No, I think not. You look at the ways in which Wall Street is rebuilding, adopting very similar practices to those from a few years ago. I don't see that we've yet achieved this. And there is a sense in which it's going to be very difficult to rein back the financial sector through regulation. But HSBC itself, I just held up as a great example, is thinking about moving out of the UK because of the regulations and moving its headquarters to Hong Kong. Within an international context, regulation by any individual market or even coordinated regulation is difficult to achieve. And that takes us back to us as clients and owners of the investment industry, because we are. We both own banks and invest through them and in them. We have an opportunity through that ownership and through our being clients to moderate their behavior. We've really only scratched at the surface as to what's possible through proper coordinated engagement with companies, including banks. So I think we need to look to ourselves. In terms of fiduciary, my working definition is the duty of trust, which I think is what the trustee is or should be looking after. So your fiduciary duty as trustees is the duty of trust, and what's entrusted to you is the retirement wealth or well-being of the beneficiaries of the funds that you're looking after. And the interpretation of that then from a financial perspective is generally short-term, and that's our problem, which is that it seems then okay to lend the stock, for example, within the fund in order to generate a return in the short term, when that lent stock may well be, and probably is, being used against your long-term interests or long position by hedge funds and others, who you might be investing through as well. It gets worse. So there is a real problem of a lack of joined-up thinking within, I think, investment, and in particular short-term interpretation of the duty of trust. A couple of law firms, Freshfields is one, have attempted to look at this, and I don't have the reference, but you could Google Freshfields and fiduciary duty, and I think you'll find it. And they've said, in their view, not taking a long-term perspective is a derogation of fiduciary duty. Not many have been so bold, but I think it does need further attention also.
It's very clear from what both of you have said that we have an ongoing agency issue to manage, that all of us just about outsource our equity management. So that whilst many of us have taken some control over the way we deal with proxy voting and engagement, very substantial control of that I would suggest, we haven't really solved the problem of dealing with the issues that arose in 7 and would have arisen or did nearly arise in Qantas, which I think was much more serious than Channel 7, frankly. Mixing tractors with television stations may not be good, but giving Alco control of Qantas would have been an absolute disaster. And it was saved really by the action of just a couple of fund managers. So I think, giving Dean a chance to just comment on what I'm saying, that the failure in 7 was that we had meetings with the company. All of our members were briefed, and not everybody I understand in the room is a member, but most of you are, had full briefings before that meeting and then after that meeting, but somewhere along the line after that, the fund managers behaved as they wanted to behave. And that seemed to me to be our failing in dealing adequately with that, and would have been with Qantas. Somebody else saved us in Qantas, not us.
Yeah. Well, a comment on the 7. I don't think it's a binary thing. I think it's far too early to say whether it's been a value destructive thing or not. My comments are really that what it showed to me is that the whole process basically stunk. And what was claimed as a governance victory by the fund managers, who very earnestly and honestly did their job at the end, really was so slapdash. I mean, to give you an example, the deed, what happened was there was an earnings guarantee put in place, whereby if Stokes missed the earnings target for WestTrac by $1, he would forfeit $115 million worth of shares. Now, who in their right mind would enter into that deal? It tells you that, honestly, they didn't think that it was a value at all. But regardless of that, when I looked at the deed that put it in place, I was staggered. They had the wrong name on it. The wrong name. So I called ASIC and I said, look, what are you doing? This is absolutely crazy. You can't put this out into the public domain. So they ran off to the federal court. They made the company effect another deed with a different party. And whereas the Financial Review had everyone on the front page of, Perennial and Ausbil were on the front page saying this is a great victory for shareholders. And I called Peter Gamble, who was the CEO of 7, and asked him a number of questions about the deed. And I said, well, what about the dividends? So the idea would be if you missed your earnings target, you would give up this amount of shares. And it's, the dividends didn't get into the deed. So the roughly $5 million worth of dividends would have been paid out on the basis of those shares being issued. We forgot. So the process just stunk to me. We're so obsessed with having the appearance to the super fund clients of being, right on top of corporate governance issues that we lose the detail. And, frankly, I feel, or I felt at the time how ridiculous it was that there were basically 3 blokes with a slingshot asking these questions of the people, when the entire finance industry, the head of Goldman Sachs, the head of JP Morgan, the head of Grand Samuel, are all cheerleading this on with impunity. It just doesn't seem right to me. So.
I'm not sure that you answered my question, but I won't. You're allowed to vent your frustration, Bridget. David.
My question has, I suppose, to you, Colin. Recent trip to China last year. I took the opportunity to meet with some of the Chinese investment companies, CIC in particular, Chinese Investment Corp, and we got into a broader discussion about some of their private equity forays and how they were looking, I suppose, to raise some additional capital. I then actually asked that silly question, so what are your fees? And they said, oh, it's 2 and 20. And I said, well, why is that? And they said, oh, that's the market. That's the market. I was just wondering, in the context of, obviously, as we see the rise in Asia, China specifically, as these developed countries, the frontier countries, I suppose, move more and more towards an open market economy or quasi-open market economy, I've got no doubt that some of the practices that they will look to inherit will actually include the various incentive structures and fee structures that we see played out today, and some of the things, I suppose, that you and Dean have alluded to. What work, if any, is being done in those countries to try and get to them before, I suppose, some of these things become embedded in their culture?
Yes, I doubt we can do much about that. It's the nature of the financial services industry is that it adopts these practices and works almost cartel-like. There seems very little competition on fees, rather more complacency. And I think that will arise in these markets too. I do hope, though, and as I've said, maybe I'm being a little optimistic, and maybe the next bull run across the markets all this will go away. But I have seen within the UK very recently the development, as I've said, of a concept of responsible asset management, which seeks greater alignment with the client. And I hope we're going to see more of that, and that will develop further. So the fund manager, if you like, taking the initiative, even though the client doesn't seem to be demanding this, to offer the client better terms and to look after the client, going back to perhaps an older way of operating, as you used to get in the City of London, whereby you thought about the client relationship as a long-term one, rather than the one where you sought short-term gain. Again, early in my career, this time at Baillie Gifford in Edinburgh, one of my colleagues who was very much an unreconstructed sort of fund manager said, Colin, I was wittering on, as I often do, about long-termism. And he said, but Colin, the long term is surely just a series of short terms. And I said, well, that may be how it looks to you. But you're benefiting from that short-term series, whereas your clients are not. And that's kind of the problem, I think, within investment markets. And that would be true then of fees as well. So I'm not optimistic globally, but perhaps locally we're seeing some variation in practice, and I do hope that develops.